Our next area is capital structure part 1. Question number 1. The marketable securities with the least amount of default risk are repurchase agreements. What are these agreements? These are the agreements mostly between security traders or dealers who sell their securities for, let's say, $100,000 to a person A with this promise that they will buy it back at $105,000 after 3 months, let's say. So such agreements are called repurchase agreements. So yes, they are enforced by law, but there is high counterparty default risk. So they have risk. Banker acceptances, the draft, the bill of exchange that has been accepted by the banker for payment. So the party that has requested the bank to accept the draft or bill of exchange may default. So yes, there is a risk of default. Federal government agency securities, like Federal Housing Finance Agency, such securities are backed by the federal government, but the securities issued by the US Treasury, comparatively, both have low risk, but this one is considered to be riskless, default risk free. So this means comparatively C and D, we would go for D, and that's why it makes it the right answer. Next, Larson Corporation issued 20 million of long-term debt in the current year. What is a major advantage to Larson with the debt issuance? First, the increased financial risk resulting from the use of the debt. The statement is correct. When you issue debt, the financial risk increases, but this is not an advantage. It's a disadvantage. We are looking for an advantage. The relatively low after-tax cost of debt due to the interest deduction. This is true because interest is a valid tax deductible expense, which means the interest we pay, it is allowed expense under the tax laws, so it would result in lower tax. That is why this tax shield of debt makes debt a lesser costly source of finance, whereas there is no such tax deductibility for dividends. Preferred stock dividends or common stock dividend, they are not tax deductible. So that is the reason debt has a relatively low after-tax cost due to interest deduction. Interest is a tax allowable expense, hence it reduces your tax. The reduced earnings per share possible through financial leverage. This is wrong. Financial leverage means you just have to pay a certain amount of interest. The rest of the sizable earnings are for the common stockholders. Thereby, earnings per share are normally higher through financial leverage. This is incorrect. The reduction of Larson's control over the company. When you issue debt, you're not selling the ownership stake in the company. So control is still with the company. So the correct option is B. Alright, next. The principal measure of non-diversifiable risk that cannot be diversified through portfolio construction, included in the Kappam formula is the beta coefficient. The beta coefficient measures the volatility or risk inherent in an investment by, let me show you. This is your Kappam formula. Required rate of return, which I normally write as ER, is risk-free rate plus beta times return on the market minus risk-free rate. We are talking about this beta coefficient. The proper formula to calculate beta is the covariance of the return on the market and the return on the asset divided by the variance of returns on the market. This is the proper formula, but you are not supposed to use this formula. Then what you would be using, let's say this is your specific security, which has increased in value by 10% and the overall market has gone up by, let's say, 20%. Now the beta coefficient is equal to the ratio of the percentage changes in the stock price, which is 10%, divided by the percentage changes in overall market values, that is 20%. So if you do simplify, it's going to be 0.5. So this is the formula you're supposed to do. This is what we do in ACCA and CA, but in your syllabus, the beta coefficient is to be calculated this way, and that would make B to be your correct option. Computing the ratio of percentage changes in the stock's price to the percentage changes in the overall market values during the same period. Next, what does beta measure in the capital asset pricing model? I just told you a little while ago, beta measures the volatility of the stock with reference to the overall volatility in the market. So basically, driven from this one, see the overall volatility of the market and the volatility of that single stock, how are they correlated? That's what beta measures. So it measures the volatility of stock relative to the market. That makes A to be the correct option. Next, the optimal capitalization for an organization usually can be determined by how well they have lowered their overall weighted average cost of capital, the lowest total weighted average cost of capital. If the WACC is the lowest, this would be the way to maximize shareholders' equity. So that's why it makes C to be the correct option. Which of the following firms' sources of new capital usually has the lowest after-tax cost? Common stock, the riskiest amongst all, has the highest cost of capital. Retained earning and common stock assumed to have the same cost of funds. Preferred stock will have lower, and bonds, because of interest rate tax deductibility, it would have the lowest after-tax cost, and that's why D is the right answer. Which of the following rates is most commonly compared to internal rate of return to evaluate whether to make an investment? IRR is normally compared with weighted average cost of capital, our aggregate cost of funds. What's the cost to us? Aggregate in total all the different sources we use: retained earnings, common stock, preferred stock, debts. So how the project's IRR compares to the weighted average cost of capital? If your project has no risk at all, then you may go for the risk-free rate. Otherwise, we compare our IRR with the weighted average cost of capital. Which of the following factors might cause a firm to increase the debt in its financial structure? When you would take more debt, more bonds are issued. When an increase in the price-earning ratio is desired. Well, if you issue bonds, that will lower your share price, because bonds and loans are considered to be detrimental to the interest of the investors. Share price falls. When the share price falls, price to earning will fall, not increase. An increase in the corporate income tax rate. That is true. When the corporate income tax rate increases, let me show you how it would work. Let's say right now the tax rate, let's say it's 20%. And if a firm that has issued certain bonds at the coupon rate of, let's say, 5%. So if you calculate the after-tax cost of debt after tax, it's coupon times 1 minus tax rate, which means 5% times 80 is going to be 4%. Now let's say if we just issue similar tranche of bonds at 5%, and if the tax rate goes up to, let's take an unusually high number, let's say 50%. Now let's calculate the new cost of debt. Now that's what we're going to issue. Let's say it's going to be same coupon 5% times 1 minus 50%. Look at this, what has happened. Your cost of debt, the after-tax cost of debt, has fallen to just 2.5%. That is the reason when the corporation income tax rate increases, this would lower your cost of debt, and that would make B to be the correct option. Why not C? A decrease in the times interest earned ratio, which is a desperate situation, not viewed favorably by the investors, the bond investors. So this is not the right situation to issue further bonds or take more debt. Increase economic uncertainty. When there is economic uncertainty, the leverage must be avoided. Operating leverage as well as financial leverage. So this is not true as well. All right, next question. When calculating a company's cost of capital or cost of common stock, an analyst evaluates the following 4 components: risk-free rate, stock beta, the rate of return on the market portfolio, which I normally refer to as RM, and the required rate of return, which you can call R, ER or RE, whatever. So these are the components of your capital asset pricing model. So its expected return is equal to risk-free rate plus beta times the return on the market minus risk-free rate. So that will give you A to be the correct option. A it is. Next, this is a good one, an extended one requiring some computation. Let's see what we have here. Whenever you come across a bigger question like this, as you can see, it is always recommended to read the requirement first. That will save a lot of time for you. An analysis of Youngstone's planned equity financing using the capital asset pricing model would incorporate only we just discussed that when you use Kappam, you need risk-free rate, you need beta, you need return on the market portfolio, and this will help you calculate the expected return. So what we are talking about, expected market return, the current US Treasury bond yield, that's RF, the beta coefficient, and of course one element, the return on the market. So let's see any other option has the same combination. The current US Treasury bond yield, yes. Price earning ratio, no. The beta coefficient, yes. Expected market return, yes. The price earning ratio, no. Current US Treasury bonds, yes. And the dividend payout ratio, no. So clearly the correct option with the right combination is option A. Next. See, we didn't have to read, but let's just go through it, what it was all about. Youngstown Electric is considering new projects for the next year that will require $30 million of the new financing. In keeping with its capital structure, Youngstown plans to use debt and equity financing. This much $10 million 20 years bond at a price of 101.5 with a coupon of 10% and flotation cost of this. Use of internal funds generated from retained earnings. This equity market is expected to earn 15%, that is RM. US Treasury bonds currently are yielding 9%, that's RF. The beta coefficient for Youngstown's common stock is estimated to be 0.8, less volatile than the market. Youngstown is subject to 40% corporation income tax rate and all that. There's nothing special in it. Moving on, the cost of debt most frequently is measured as, so what we have done so far, interest rate adjusted for tax saving. In other words, actual interest rate minus tax saving. No inflation or risk premium is involved here. So we got B to be the correct option. Capital investments require balancing risk and return. Fine. Managers have a responsibility to ensure that the investments that they make in their own firms increase shareholders' value. Managers have met that responsibility if the return on the capital investment is more than the rate of return associated with the firm's beta factor. In other words, you earn more than what it costs you, not less, not greater than the prime rate of return. Prime rate of return is the rate at which the bankers would lend money to their trustworthy customers. So this is A clearly. You need to earn more than what it cost you. Which of the following observations regarding the valuation of bonds is correct? When the interest rates rise, so that the required rate of return increases. That is true up to this point. The market value of the bond will increase. Wrong. Listen to me very carefully. When interest rate rise, the bond's price fall. And when the interest rates fall, the bond price would increase. So this is an incorrect statement. B. For a given change in the required return, the shorter its maturity, the greater the change in the market value of the bond. Well, that is incorrect. In fact, the longer the maturity, the greater the change in the market value of the bond. In other words, a short-term maturity bond will have less volatility in price, whereas a long-term bond will have greater volatility and greater change in the market value of the bond. So this is incorrect as well. The market value of a discount bond is greater than its face value during the period of rising interest rates. Okay, a little overview regarding discount bond and the bond issued at premium. Let's say if you have offered a coupon rate of, or the stated rate of 10%, let's say, whereas the effective market rate at that point when the bonds were issued was 15%. Since you are offering a lower rate than the market rate, so your bond will sell at a discount. A $1,000 bond may be sold at $950, right? So this is the situation when the discount bond is issued. On the other side, if your stated rate is, or the coupon rate is 10%, and the market rate at that point when we issued the bonds was 7%, now you are offering a higher rate than the market rate. In this case, your bond will sell at a premium, right? Now look at this option C. The market value for discount bond, which is already given lower rate than the market rate, is greater than its face value when the period of rising interest rates. When the interest rates are further rising, so how is it possible for a discount bond to sell at a value greater than the face value? So this is incorrect. Then what about option D? When the market rate of return is less than the stated rate, as the case here, market rate is less than the stated rate, the market value of the bond will be more than the face value and the bond will be selling at a premium. A $1,000 bond, if issued at 10% coupon, while the market rate at that point was 7%, so the bond might sell at, let's say, 1,050. So that is true, absolutely true, and that makes D to be the correct option. The overall cost of capital is the rate of return on assets that covers the cost associated with the funds employed. We have issued bonds, we have issued preferred stock, common stock. So these funds are not cost-free, they have to generate some returns for the investors. So the rate of return on the assets that have been funded through these sources is your overall cost of capital. That is correct option. Why not be minimum rate of return must earn on high risk projects? So this is the desired rate of return, not the overall cost of capital, and you would have the equally valid reasons for rejecting the incorrect options. The benefit of debt financing over the equity financing are likely to be highest in which of the following situations? We just learned a little while ago that interest expense is tax deductible. So if higher is the tax rate, higher would be the interest expense tax deductibility, and there will be low would be the cost of debt. So when the marginal tax rate is high, either B or D, and when there are few non-interest tax benefits. So when the tax rate is high, good for you. And there is no benefit for non-interest expenses. So in that case, you should go for more of debt financing. So that would mean higher marginal tax rates, beneficial, and corresponding there are few non-interest tax benefits, so you're not sacrificing much. So then in that case, debt financing would be the lowest cost source of fund. D is the right option. Next, the three elements needed to estimate the cost of equity capital for use in determining firm's weighted average cost of capital are either it's Kappam or the dividend discount model. Current dividends per share, expected growth rate. So we are talking about dividend discount model. So let me write it down for you. So if you want to calculate the cost of equity, or sometimes you express it with RE, it's equal to the next dividend upon the current stock price plus growth rate. So we need three things: the dividend to be paid in the coming period, the current stock price, and the dividend growth rate. And all of it is perfectly available here. Current dividend per share, that is D naught, which can always be multiplied with 1 plus growth rate. Remember, D1 is the next dividend, which can be calculated by multiplying the current dividend with 1 plus G. This will give you D1. So yes, we can use this. Expected growth rate in the dividend, that is G, and the current market price per share of common stock, that's P naught. Perfect combination. Look no further. That's your right option. Next, commercial paper is generally sold only through investment banking dealers. This is incorrect, because commercial papers can be sold through brokers, money market participants, dealers, investment brokers, so on and so forth. So this is incorrect option. Commercial paper has an interest rate lower than the treasury bill. This is again incorrect. Interest rates on commercial papers are usually below the prime rate, but they are always above the return on treasury bills. So this is not correct. Has a maturity date greater than 1 year? No. They do not have maturity date greater than 270 days. This is the maximum maturity for commercial paper. Then it has to be B. Let's read. Generally does not have an active secondary market. This is correct statement. For commercial paper, we do not have an active secondary market. The reason being that the commercial paper has a minimum denomination of $100,000, and they are only issued by the firms with the very good quality credit rating. So which means that not every firm can issue commercial paper, and not every individual or firm can invest with them. So that is the reason they do not have active secondary market, and that's the option that is correct. So click B and move on. Which of the following types of bonds is most likely to maintain a constant market value? Well, this is a pretty straightforward question. Remember, floating rate bonds, they would automatically adjust the return according to the changing market rates. So in such a situation, on such bonds, no premium or discount would be needed, since the market changes would be accounted for through the changes in interest rates. So it's also called floater. So this is the right option. Moving on, which of the following responses is not an advantage to a corporation that uses the commercial paper market for short-term financing? Not an advantage. So that's what we need. We need the one that carries no advantage. There are no restrictions as to the type of corporation that can enter into this market. Well, this is the correct option. This is not an advantage, because only firm with the good credit score, the credit-worthy large corporations, only they can issue commercial paper, because I told you that the minimum denomination of a commercial paper is $100,000 or more. So it's not that small firms can issue, nor they can invest in it. So this is basically not an advantage. Let's see the other. Are the benefits? A benefit accrues to the borrower because its name becomes more widely known. When you issue commercial paper, so your existing credibility is there, but it will still enhance your credit worthiness, or it will make your name well known to the investor. So that's what it means. So it's true. The borrower avoids the expense of maintaining a compensating balance with the commercial bank. Yes, you don't need a compensating balance. You need money. Go ahead, issue commercial paper rather than going for the bank for funding arrangements with the compensating balance requirement. So this is a benefit. This was the benefit. This market provides a broad distribution for borrowing. This is also correct option, because commercial paper does provide broad distribution for borrowing. So that makes A, which is not an advantage. Not every firm can issue, so that is our right option. Well, it's a pretty straightforward question. Using the Kappam or the capital asset pricing model, the required rate of return for the firm is to be calculated. I would call it ER. That's what I've been writing over the last 20 years, with a beta of 1.25. When the market return is 14%, that is RM, and RF is 6. You have everything you need. You have everything. So it's going to be ER is equal to risk-free rate, that is 6%, plus beta 1.25, return on the market 14, risk-free rate 6%, and if you do the simplification, it should give you 16%. So that would make B to be the correct option. And B it is. All right. Martin Corporation statement of financial position is given. What else? This much is given. I told you a little while earlier, and listen to me very carefully. Whenever you see a bigger question, I would say more than the usual length of the question, it is always recommended to read the requirements so you know exactly what I need to look for. Using the capital asset pricing model, Martin's current cost of capital or current cost of common equity. So I just need three things. I need risk-free rate, I need the return on the market portfolio, and I need the beta. That's all. And this is all given. The current risk-free rate is 7%, the beta is 1.25, and the expected return on the market portfolio is 15. So that's all what you need. Risk-free rate is 7%, beta is 1.25, return on the market is 15, and the risk-free rate is 7. So it's going to be 15 minus 7, 8, 8 into 1.25, and to the add 7. So it's going to be 10, 7, 17%. Khalas, I didn't have to do a lot of reading. I just focused on what I needed, and I just extracted the relevant information, and that was simple. So D is the right answer. And D it is. Next, Bender Company is determining how to finance some long-term projects. Bender has decided it prefers benefits of no fixed charge. Okay, if you need no fixed charge, then forget about short-term debt, forget about long-term debt, forget about bonds. No fixed charge. You avoid fixed charge. No fixed maturity date. So that means no short-term debt, no long-term debt, no bonds. And an increase in the creditworthiness. Creditworthiness can be increased by issuing common stock. That will increase your credibility in the market. So look no further. Which of the following would best meet Bander's financing requirements? Common stock, and that is D. This is a beautiful, lovely question here. So instead of reading all through from A to Z, just look at what is required. Compute DQZ's expected rate of return using the capital asset pricing model, which I need risk-free rate, which is given here. Treasury bonds are currently yielding 5%, that is RF. I need expected return on the market portfolio, 12%, and I need beta. So just plug in the numbers and you will get your answer. So ER is equal to risk-free rate plus beta 0.6, and then return on the market, that is 12%, less risk-free rate. So if you simplify this, 5% plus 0.6 times 7%, and it's going to be 5% plus 4.2 is going to be 9.2%, and that perfectly matches with your option D. Okay, next. A company has the following financial information. We have given long-term debt, preferred stock, common stock with their proportions and the component costs of long-term debt, preferred stock and common stock. No tax is given. That means just take what is given, 7.1 for long-term debts. Otherwise, we need to take it after tax basis. To maximize shareholders' wealth, the company would most likely establish a hurdle rate that would limit acceptance of projects to only those with the minimum returns greater than what percent? So minimum return, here we have three different sources of finance. So our project must earn more than our weighted average cost of capital. So we have 60% funds at 7.1%, 20% funds at 10.5% cost, and 20% of funds come at 14.2. There is no tax. Otherwise, had there been tax given, we would have multiplied 7.1% with 1 minus the tax rate, let's say 40%, because tax component must be taken on after tax basis. So if you just do the computation, the total should come out to be 9.2%. This is not required here because the tax rate isn't given. So that makes B to be the correct option. Next. Okay, something similar we have done earlier. But look at the requirement. Assume that the after-tax cost of debt is 7% already given, and the cost of equity is 12%. Determine the weighted average cost of capital. So basically, it's a very straightforward question requiring no sifting through the text here. Just put in the percentages in the formula and get your answer. So weighted average cost of capital is equal to, we have a total investment requirement of 50 million, out of which 15 million will come from debt and 35 million will come from equity. That is 70% of your total funding needs, and this is 30%. So what you're going to do, WACC is equal to 30% proportion comes from debt at a cost of 7% after tax, plus the remaining 70% of your funding will come at a cost of 12%. So what you have to do, just calculate and you'll get your answer. 30% funds at 7% cost and 70% funds come at 12% cost gives you an aggregate weighted average of 10.5%. That perfectly matches with your option D. Alright, ABC company had debt with a market value of 1 million and an after-tax cost of financing of 8%. ABC also had equity with a market value of 2 million and a cost of equity capital of 9%. ABC's weighted average cost of capital would be. Now, WACC can be directly calculated. If you can see 1 and 2, that means 33.33% funds have come from debt and remaining 66.67% from equity. Or you can do this way: 1/3 of the funds come from debt at a cost of 8% and 2/3 come from equity at a cost of 9%. Next, you just have to simplify. 8's 1/3 plus 9's 2/3 gives you a total of 8.667%. That is closely 8.7. Click A and move on. Now this is a beautiful question. The following information is available on market interest rates. The risk-free rate is 2%, inflation premium is 1%, default risk premium is 3%, liquidity premium 2%, and maturity risk premium 1%. Now let's say I invest in US Treasury bills, T-bills, which are effectively risk-free. But since I am always facing constantly rising level of prices, I must be compensated for the inflation premium. So it means my desired rate of return would be 3%. Now, let's say I have another instrument, a bond X, for example. Now, this bond may default. So, in order to protect myself from this default, I must be paid a higher return and I must be paid a default risk premium. Now, let's take another instrument that has a default possibility for which I'm expecting 3%. Let's say take it B. Now, this investment is comparatively illiquid. I cannot sell it quickly in the market without giving price concessions. So I must be compensated through what you call liquidity premium. So my desired rate of return will be 2, 3, 6, 8. For this I need 8%. For this I need 3 plus 2, 5, 6%. For T-bills I need inflation premium together with it is 3%. Now I invest in a certain investment Y that has all these included, but I may have to wait for a longer time period to allow the investment to mature. So I must be paid another premium called the maturity risk premium. So then I would be looking for a return of 9%. So what is the question here? What is the market rate of interest on a 1-year US Treasury bill? So I need these two. That's 3%. So that means my option would be somewhere down here. That is the right answer. Next, the capital structure of a firm includes bonds with a coupon rate of 12% and an effective interest rate of 14%. The corporate tax rate is 30%. What is the firm's net cost of debt? Now listen to me very, very, very carefully. If you have been given the coupon at which the firm pays interest, remember coupon rate is used for interest payment to the bondholders. But the effective interest rate, 14%, is the rate calculated based upon the firm's market price. That is more relevant than 12%. I'm going to take 14%. But since tax rate is given, so it has to be given on after tax basis. So it's going to be 14%, that is the effective interest rate, multiplied by 1 minus tax rate. So it's going to be 14% times 70%. And that is going to be 14 times 70, 9.8%. And that perfectly matches with your option D. And D it is. Next, Sencorp, a publicly traded mid-cap company. Mid-cap company normally is the company that has a market capitalization of between 2 to 8 or $10 billion. So it wanted to obtain $30 million in new capital to expand its Iowa plant. Cost of capital was a factor in making this decision. Sencorp could either issue new preferred stock or new debentures. Two options are being contemplated. Sencorp's underwriter estimated that the preferred stock would or should have an annual dividend payout of 6% and an issue price of 103. So that's the annual dividend. This is the issue price. The debenture should have a coupon interest rate of 9% and an issue price of 101. Sencorp's marginal income tax rate was 40%. Which of the following approaches describe Sencorp's best strategy? So what you're going to do, you're going to calculate the cost of individual components. This one means annual dividend. I hope you remember cost of preferred stock, and I prefer to write it as KPS. $6 is the annual dividend and the issue price is 103. This will give you 6, so 103, that is 5.83 approximately, 5.83%. Now, if you go for debt interest is 9%, that means $9. The issue price of the bond is 101. Don't forget that interest expense is tax deductible, so you will have to multiply it with 1 minus tax rate, which is 40% in this case, And now if you simplify this, 9 by 101 times 60%, that is 5.35 approximately, 5.35%. So if you just look at this, debt is marginally less costly. So Sencorp should issue debentures, debt, since the after-tax cost of debt is 5.347, which is less than the cost of equity, that is 6%. No, cost of equity is not 6, it's 5.83. This is not right. This is not right. 9, 5.8, this is not right. Yes, debentures at 5.34 and cost of equity 5.825. Perfect. D is the right option. And D it is. A company has the following target capital structure and cost. These are the proportions of capital structure. These are the component cost of debt, common stock and preferred stock. Now this is important. We have been given the tax rate. So it means we must multiply this component cost of debt with 1 minus 30%, and that will give you a net of 7% to be precise. Now we need the weighted average cost of capital, and I'm sure you know what to do. 30% funds have come at 7% cost, 60 at 12%, and remaining 10% at a cost of 10%. So if you do the computation, let me do it for you. 0.3 times 7 plus 0.6 times 12 plus 0.1 times 10 gives you 10.3, and this is your weighted average cost of capital, and that perfectly matches with your option A, and A it is. Dividends are equal to $5 and the current share price is 50. Dividends are expected to grow at 2% forever. According to dividends growth model, what is the investor's required rate of return? For that you need to know the formula. The required rate of return, or KE, or whatever you call it, it's equal to dividend next upon the current share price P0 plus growth rate. So dividend given right here, it is not D1, it is D0. And we know D1 is equal to D0 into 1 plus growth rate upon the current share price plus G. Just plug in the numbers, you will get your answer. So it's going to be 5 into 1 plus 2%, that's going to be 1.02 upon the current share price, that is 50, and multiply this with 100 in order to convert it into percentage. Whatever the result comes, that's basically the dividend yield. To this add the constant growth till eternity and add these up, you should get 12.2%, and that perfectly matches with your option B. Next, a company recently issued 9% preferred stock. That's the 9% means $9 if it is a par of 100. Dividend, the preferred stock sold for 40 a share with a par of 20. Okay, this question is interesting. It has not 100 par, it's 20. The cost of issuance, the stock was 5 per share. What is the company's cost of preferred stock? I hope you remember the formula. The cost of preferred stock is equal to the dividend divided by what I call the NIP, net issue proceeds. The dividend that you're going to pay is 9% of par, which is going to be $1.8. Remember, the dividend and the interest payment is made upon the par. So 9% of 20 is 1.8. And what is the net issue proceed? You sold the preferred stock at 40, but in order to get 40, you had to pay 5 as the issuance cost. So what you received net, called the net issue proceed, is 40 minus 5, 35. So it's going to be 1.8 upon 35 into 100. 1.8 upon 35 into 100. It gives me 5.14, and 5.1 approximately is the right answer. It's D. And D it is. Next, Datacom Industries, which has no current debt, has a beta of 0.95 for its common stock. Management is considering a change in the capital structure to 30 debt and 70 equity. This change would increase the beta on the stock to 1.05, and the after-tax cost of debt will be 7.5%. The expected return on equity is 16%, and the risk-free rate is 6%. Should the Datacom management proceed with the capital structure change? So in order to manage this question, you have to see things clearly. We are looking for the WACC before the capital structure change and WACC after the capital structure change. So we are going to call it WACC 1 before the change in capital structure. Since before the change there is no debt, it's entirely equity, so it means WACC would simply be the Kappam application. So risk-free rate plus beta times return on the market minus risk-free rate. So risk-free rate is given as 6%, beta is given as 0.95, return on the market is expected to be 16% given right here, and risk-free rate is already given as 6%. So 16 minus 6, 10 times 9.95 is going to be 9.5 plus 6 is going to be 15.5%. So this is your existing WACC, entirely made up of equity. Now, if we go for debt and equity, in which debt is going to be a total 30% of our funding, and equity is going to be the remaining 70%. Let's see the component cost of these separately. Let's calculate the cost of debt and then the cost of equity, and then plug it in to calculate the new WACC. So what has changed? Only beta 1.05. Risk-free rate stays the same. Expected return on the market stays the same. So it's going to be cost of equity is equal to risk-free rate, which is 6%, plus beta, with the, now this is 1.05 times the difference between the return on the market and the risk-free rate, that is 10. So if you simplify this, 10% times 1.05, 10.5 plus 6, 16.5, which means the cost of equity new is 16.5%. What about debt? It's given right here. After tax cost of debt is 7.5%. So you have 30% of your funding from debt at 7.5 and 70% of your funding at 16.5. So your aggregate or weighted average cost of funds would be, or weighted average cost of capital, 0.3 times 7.5 plus 0.7 times 16.5 is going to be 13.8. That is good. If you compare this new WACC with the existing one, so it appears that we should go for the new capital structure. So the result is yes, we should go for the change because it will reduce your weighted average cost of capital. That makes A to be the correct option. Using the discounted cash flow method, estimate the cost of retained earning for a firm with a stock price of 30, that is P0, an estimated dividend at the end of the first year, that is D1, 3, and an expected growth rate of 10%. It's a very straightforward question. You just have to plug in the numbers to find the cost of equity. The next dividend given is going to be $3. The current share price is 30. Convert this into percentage by multiplying to 100, and to this add the constant growth rate and you will get your answer. So I believe it's going to be 3 by 30 times 100. To this add 10, so it's going to be a straightforward 20%. So that would make B to be the correct option. And B it should be. Base Corporation has $100,000 in bonds payable with a fair market value of 120. It also has 1,000 common shares issued at 50 per share with a fair market value of 80 per share. What amount represents the corporation market capitalization? Remember, market capitalization is the shares outstanding multiplied by the current fair value of the stock. So it's going to be just 80,000. It's a very straightforward question with no twist whatsoever. The companies provide the following financial information: cost of equity, cost of debt, tax rate, debt to equity ratio. What is the company's weighted average cost of capital? Now this is interesting. So what you're going to do, debt, equity. Debt is 0.8 times of equity, which means if equity is 1, debt is going to be 0.8. Right? So if you just combine 0.8, 1 is 1.8. So 0.8 is what fraction of 1.8? So 0.8 upon 1.8 is going to be 44.44%. And of course the remaining would be equity. 1 minus 0.444, or simply it's going to be 55.56. So whichever way you want to do it, simple proportion. So no science involved here. So he has also given you the cost of equity to be 20%. And remember, the cost of debt is 8%, must be taken on after tax basis. So it's going to be 8 times 60, 4.8%. And that's simple. WACC now is equal to 44% of your funds have come at a cost of 4.8, and remaining 56 55.56% funds have come at a cost of 20%, so it gives you a total aggregated cost of capital of 13.24%, which approximately is rounded off, gives you C. Which of the following factors would not be relevant when determining the risk premium on a specific security? Relative liquidity, yes, we just discussed there is a liquidity premium, so yes, it is considered. Relative seniority, yes, a more senior bond will have low cost and less senior will have high cost. Earning per share, this is the measure of profitability. And length of maturity for maturity premium. So A, B and D are relevant when determining the risk premium on a specific security, not EPS. It's a measure of profitability. Okay, now we have been given information. What exactly are we looking for? Based on this assumption, what is the current net after-tax cost of debt for Martin Corporation? Just cost of debt, so means you just need to look at the debt-related information from this question. Okay, assume the following facts about Martin Corporation. Long-term debt originally issued at $1,000 per bond, current price 1250. Martin Corporation can now issue debt at 150 basis point over US Treasury bonds. So 150 basis point means 1.5%. Above US Treasury bonds, that is currently trading at 7%, so it means 7 plus 1.5, 8.5. Do not jump. D is not the right answer. We have to give it on after-tax or net after-tax cost basis. So for that, what you're going to do, take 8.5% and multiply it with 1 minus tax rate, which is given as 40%. So it's going to be 8.5 times 0.6, 5.1%. So this is your net after-tax cost of debt, and that makes A to be the correct option. Again, just look at what is needed. Which of the following investments has the greatest reward risk ratio if a return standard deviation is an accurate assessment of investment risk? Standard deviation is the volatility in returns, and if it is considered to be an accurate assessment of investment risk, then find the ratio with the greatest reward risk ratio. An accountant has been retained by a company as an investment advisor for its employees. Research and historical rates of return yields the following information. We need a return or reward risk ratio. So for the first one, 12:20, if simplified, will give me 3.5. So the first one, 3.5. The second, 6:8, is going to be 3.4. This one is going to be 1.1. And all these so far are less than 1. But look at this one, 4:3. This is clearly greater than 1. So reward per standard deviation, unit of standard deviation, it is the highest. So this one has the greatest reward risk ratio. So go for US Treasury bills, and that would make B to be our correct option. And B it should be. A company issued common stock and preferred stock. Projected growth rate of the common stock is 5%. The current quarterly dividends on preferred stock is 1.6. The current market price of the preferred stock is 80, and the current market price of the common stock is 95. What is the expected rate of return on preferred stock? It is fairly simple. Dividend upon the market price. Cost of preferred stock, or the desired rate of return on preferred stock, is the dividend divided by the current market price. Now look at this. For preferred stock, the dividend is given on quarterly basis, 1.6 each quarter, which means on annual basis going to be 1.6 multiplied by 4, and the current market price given is 80. So it's going to be 1.6 multiplied by 4, that is 6.4 divided by 80, and convert this into percentage. It's a straightforward percentage 8, and that matches with the option D perfectly. So gentlemen, that ends your MCQ session on capital structure part 1.